Welcome to The Explainer. Today, we're going to tackle one of the best problems an investor can have, but it's a problem nonetheless. What do you do when one of your investments does so well that it's now your single biggest risk? We're going to explore how you can manage those massive winners without getting absolutely crushed by an equally massive tax bill.
So let's just paint a picture here. You did everything right. You found a great company, you held on through thick and thin, and it just grew and grew and grew some more. And now that one stock makes up a huge chunk of your entire portfolio. What started as a brilliant move has slowly turned into a huge concentration risk. A single bad earnings report for that company could jeopardize a massive portion of your net worth.
And this leads to what we call the golden handcuffs. It's a classic dilemma. On one hand, you know you should probably sell some of it to rebalance and lower your risk, but the minute you hit that sell button, you trigger a capital gains tax event. And if the gain is big, that tax bill can be absolutely staggering. On the other hand, you could just do nothing. Hold on, hope the ride continues up. But now you're basically sitting on a ticking time bomb, just waiting for a market downturn to wipe out all those years of gains. So what do? Do you write a fat check to the tax man, or do you roll the dice with the market?
To really get a feel for what's at stake, we have to talk about the destructive power of taxes. It's a force that so many investors just completely underestimate. They think they can just jump in and out of stocks. But the cost of paying taxes over and over, year after year, is like a massive anchor dragging down your returns. This next chart makes it incredibly clear.
Just look at this. This is the raw power of tax deferral in action. Both of these start with $50,000 and get a 10% return every year for 20 years. Now the buy and hold investor, they just let it ride, letting it compound, and they only pay taxes once, way at the very end. But the trader sells every year, pays the much higher short-term capital gains tax, and then reinvests whatever's left over. The difference is absolutely jaw-dropping. The buy and hold portfolio is almost twice as big. That right there is the hidden cost of taxes, and it's exactly why learning to rebalance the smart way is a cornerstone of building real wealth. Okay, so now that we've framed the problem, here's our game plan. We're going to cover the basic tax rules, then get into some really cool strategies for rebalancing without selling. We'll even look at a special tool for real estate. And finally, we'll talk about how this all fits into your portfolio design. All right, let's dive in. All right, let's get into our first section here, talking about the foundational tools. Before we get into any of the fancy stuff, you have to master the basics. See, the goal isn't to fight the tax code. You're not going to win that fight. The goal is to understand the rules of the game so you can work with it. Okay, rule number one, the most important rule of all, is the difference between short-term and long-term capital gains. If you sell something you've held for a year or less, you pay taxes at your regular income tax rate, which can be pretty high. But if you hold that exact same asset for more than a year, just one single day longer, boom, you qualify for the much, much lower long-term capital gains rates. This one simple rule is a massive incentive to think long-term, and it's really the bedrock of tax-efficient investing. Now, the absolute easiest place to rebalance your portfolio is inside what we call a tax-advantaged account. We're talking about your IRA, your Roth IRA, your 401k. Think of these accounts as your personal sandbox. Inside of them, you can buy and sell stocks, ETFs, whatever you want, as much as you need to keep things in balance, and you will never get a tax bill for any of those trades. The growth is either tax-deferred or, with a Roth, totally tax-free. Now, of course, there are very strict rules about getting money in and out, but for managing your investments over your lifetime, these accounts are your simplest, most powerful tool. So that's all great, but what if your huge winner isn't in an IRA? What if you're stuck with those golden handcuffs in a regular taxable brokerage account? Well, this is where we need to break out the power tools. I'm talking about option strategies that can help you manage your risk without ever clicking that sell button. The first one is called a protective put. And the easiest way to think about it is it's literally portfolio insurance. Just like you pay an insurance premium every month to protect your car from a crash, you can pay a small premium to buy a put option. This little contract gives you the right to sell your shares at a guaranteed price, no matter how far the actual stock price might fall. It puts a solid floor under your investment and buys you some serious peace of mind. Okay, here's a quick example of how that works. Let's say you own a stock that's trading at $100 a share. You're a little nervous, so you buy a put option with a strike price of $95 and it costs you $2 a share.
Now watch what happens. If that stock totally crashes, down to $70, $60, even $50 a share, it doesn't matter. You have a contract that says you can sell your shares for $95. Your maximum loss is locked in. It's capped at just $7 per share. That's the $5 drop to your floor, plus the $2 you paid for the insurance. It gives you a clearly defined risk without having to sell right now.
Now let's flip to the other side of the coin with something called a covered call. This is like renting out the shares you already own. Someone pays you cash today, that's called a premium, in exchange for the right to buy your shares from you at a higher price down the road. It's a great way to generate some extra income, especially on a stock you think might just trade sideways for a while. That premium you collect immediately lowers your cost basis, which reduces your risk. So what's the catch? Well, you're capping your potential upside. If the stock just skyrockets past that price, you'll have to sell. But hey, you get to keep that premium no matter what happens.
So, what happens when you put these two tools together? Well, you get a strategy called a collar, and it's often described as one of the most conservative strategies out there. It's like building a protective fortress around your stock. You are simultaneously buying that downside insurance with the put while selling off some of your potential upside with the call. You're basically defining a very clear price ceiling and a price floor for your investment.
And this is where the magic really happens. Look, you own the stock, you buy the protective put to set your price floor. But we know puts cost money, right? Well, to pay for that insurance, you sell a covered call, which brings in cash. A lot of the time, you can set this up so the money you get from selling the call completely pays for the cost of buying the put. That's called a zero-cost collar, and it's an incredibly powerful way to lock in your gains within a very specific range, all without selling a single share and without paying a dime in taxes.
So those tools are fantastic for stocks, but what about other things, like real estate? Well, let's shift gears, because property investors have their own unique and unbelievably powerful tool. Seriously, this thing can feel like a tax superpower, and it can be the engine that builds a real estate empire. It's called a 1031 exchange, and it gets its name from its section in the tax code. It lets you sell an investment property, take all the money from the sale, including your entire capital gain, and roll it directly into a new investment property, all while deferring 100% of the capital gains taxes. You're basically just swapping one building for another and kicking that tax can way, way down the road. This lets all of your money keep working for you. But, and this is a huge but, this superpower comes with some very strict non-negotiable rules and deadlines. The clock starts ticking the second you close the sale on your first property. From that day, you have exactly 45 days to formally identify in writing which properties you might want to buy, and you have a total of 180 days from that initial sale date to actually close the deal on the new property. If you miss either of these deadlines by even one day, the whole thing is off. Now, the process itself has to be followed to the letter, and there's one rule that's more important than any other. When you sell that first property, the money from the sale absolutely cannot go into your personal bank account. It has to go directly to a neutral third party called a qualified intermediary, or QI. This QI holds on to your money, and then they use it to buy the new property for you. I really cannot stress this enough, and all the research is crystal clear on this. If you personally touch the money from the sale, even for a split second, the whole tax-deferred exchange is immediately and completely voided. The deal is blown up, the full capital gains tax becomes due right then and there. It is the single biggest and most critical mistake you can make in this process. Okay, so we've looked at basic tax rules, we've looked at option strategies, and we've covered the special real estate tool. Now let's zoom out and figure out how to put all of these pieces together. How do you actually design a portfolio from day one to be both resilient and tax smart? Well, a really solid portfolio design often splits your capital into two buckets, a core and a non-core. Your core, maybe that's 80% or more of your money, is all about the long term. This is where boring is beautiful. You're focused on buying quality assets, collecting dividends, building cash flow. Then you have your smaller non-core bucket. This is for everything else. More speculative ideas, educated bets where you define your risk, and those hedges we talked about that are designed to protect that all-important core. And this really shows you that real risk management isn't just one thing. It's a whole toolbox. It starts with asset allocation, owning things that don't all go up and down at the same time. It means using smart position sizing so no single bad bet can blow you up. It involves diversification so you avoid that concentration risk we started with. And finally, it includes the active use of hedges, like those puts and collars, to put a fortress around your most valuable assets. We have covered a lot of ground today, from the most basic tax rules all the way to advanced strategies for stocks and real estate. So let's bring it all home with a quick recap of the most important takeaways. So here are the 4 big ideas.
First, maximize those tax-advantaged accounts. Your IRAs and 401ks are your easiest win for tax-free rebalancing. Second, in your taxable accounts, learn how to use hedging tools. See puts and callers as insurance policies to manage your risk without having to sell. Third, if you're a real estate investor, you have to master the 1031 exchange. It's your superpower for deferring taxes. And finally, design your portfolio with a purpose. That core/non-core structure gives you a framework for long-term stability and smart risk management.
At the end of the day, these aren't just abstract ideas. They are real, actionable tools that you can learn and put to use. Managing risk and taxes isn't something that just happens to you. It's a proactive skill. It requires a well-stocked toolbox. So the real question to leave you with is this: which one of these tools are you going to learn more about and add to your own toolbox first?